David and Maria live in Colorado. Early 40s, 2 kids, good jobs. They've saved $100,000. Right now, it sits in a savings account earning about 4%. Every night after the kids go to bed, David watches trading videos. He sees people bragging about huge wins, 30% in a month, 50% in a week. He thinks maybe he should start picking stocks too. Maria watches over his shoulder. She feels the same pull, but something bothers her. Because for every winner showing off on YouTube, there are 1,000 losers who never post a video. Here's what David and Maria don't know yet, and what you will know by the end of this video. There is a simple portfolio of just 7 ETFs. Over the last decade, this blend averaged 16 to 18% per year. At 16%, $100,000 turns into $926,000 in 15 years, without picking a single stock, without watching a single candle chart. But here's the part nobody ever mentions. Roughly 2/3 of that $926,000 is made in the last 5 years of the journey. The first 10 years feel painfully slow. The last 5 feel like magic. That's the compounding curve, and it changes everything about how you think about patience. Now let me be upfront. I'm not a financial advisor. I'm not a government employee. Everything in this video is for educational purposes only. For your specific situation, always talk to a qualified professional. Here's the thing though, this portfolio looks like 7 different funds, but it's not really 7 different things. And once you see what it actually is under the hood, you'll understand exactly why it works so much better than stock picking ever could. The secret inside the portfolio: 3 bets, not 7. Most portfolio videos on YouTube show you a list of tickers. They tell you the name, they tell you the return, maybe they tell you the expense ratio, and then they move on to the next one. Nobody ever pulls back the curtain, so let me do something different. These are the 7 ETFs: VOO, SCHD, VTV, QQQM, SCHG, VGT, and SPMO. 7 funds, 7 different tickers. Sounds diversified, right? Not exactly. QQQM and SCHG are 92 to 98% correlated. That means when one moves, the other moves almost identically. VGT and QQQM 97% correlated, and 84% of what's inside QQQM is already sitting inside VOO. What looks like 7 separate bets is really 3 intentional bets wearing 7 tickers. Bet number 1 is the foundation. That's VOO, SCHD, and VTV. These are the anchor, broad market exposure, quality dividend payers, pure value stocks. When everything else drops, these hold the line. Bet number 2 is the growth engine. That's QQQM, SCHG, and VGT. These are the accelerator, technology, innovation, the companies that are building the future. Bet number 3 is the momentum boost. That's SPMO. It finds the 100 stocks in the S&P 500 with the strongest price momentum and rides the wave. Now, this concentration isn't a flaw, it's the design. You're deliberately putting 60 to 70% of the portfolio into the highest quality growth companies on the planet: Apple, Microsoft, Nvidia, Amazon, the ones that actually move the market. But you need to understand that going in, because concentration works beautifully on the way up, and it stings on the way down. So why use all 7 if it's really 3 bets? Because each ETF does something specific that the others can't, and that's what almost nobody ever explains. Let me show you. The 7 ETFs, what earns each one its spot? Let's go through each fund, not the surface level stuff you've already heard 100 times, the real mechanics underneath. VOO, the Vanguard S&P 500 ETF. Expense ratio of 0.03%. That's $3 per year on every 10,000 invested. Turnover rate of only 2% per year. This fund barely moves. It just sits there and grows. Here's the fact that should end every stock picking argument forever. According to SPIVA's 2025 scorecard, 84% of professional fund managers failed to beat this one single fund over 10 years. Let that sink in. These are professionals, Harvard MBAs, teams of analysts, Bloomberg terminals, and 84% of them lost to a fund that costs $3 per year.
VOO is the measuring stick. Everything else in this portfolio has to earn its place next to it. Next is SCHD, Schwab U.S. Dividend Equity. This is the most misunderstood fund in the entire portfolio. People think it just buys companies that pay high dividends. That's not even close. SCHD requires 10 consecutive years of dividend payments before a company can even be considered. Then it screens every candidate on 4 quality factors: cash flow to debt, return on equity, dividend yield, and 5-year dividend growth rate. But here's the part that makes SCHD truly special. Every March, this fund reconstitutes. It mechanically sells the stocks that have run up and buys beaten-down quality names at lower prices. In March 2024, it removed companies like Valero, which had run up 80%, and it added names like United Health, which had dropped 48%. That's a built-in buy low, sell high machine that operates automatically once per year. And when the market fell apart in 2022, the S&P dropped 18%. SCHD, only 3.2%. That's the quality screen doing its job. Third is VTV, Vanguard Value, the quiet one. No hype, no headlines, but VTV is the only genuine diversifier in this entire portfolio. When tech gets crushed, VTV holds the floor. Every portfolio needs a boring anchor, and VTV is exactly that. Now the growth side. QQQM tracks the NASDAQ 100. Pure growth at 0.15% per year. The upside has been extraordinary. But here's the risk you need to respect. In the 2000 to 2002 crash, the NASDAQ lost 77% of its value. 77%. If you had $100,000 in it, you were looking at $23,000. Concentration gives you the highs. It also gives you the lows. SCHG is Schwab U.S. Large Cap Growth. Yes, it overlaps with QQQM by about 44%. That overlap is intentional, but the 56% that doesn't overlap, those are large cap growth companies outside the NASDAQ. That's the reason SCHG earns a spot alongside QQQM. VGT is Vanguard Information Technology, 98% pure technology with a beta of 1.42. This is the rocket fuel. Over the last decade, it returned more than 25% per year, but it also dropped 29.7% in 2022. Highest upside, highest risk. It gets the smallest allocation for exactly that reason. And finally, SPMO, Invesco S&P 500 Momentum. This is the most interesting fund in the portfolio. Twice per year, in March and September, this fund identifies the 100 S&P 500 stocks with the strongest risk-adjusted price momentum over the past 12 months. Then, it loads up on them. Here's what's surprising. Academic research says momentum strategies should crash hard during market panics, but in 2022, SPMO actually fell less than VOO, about 10% versus 19%. That caught a lot of people off guard. But here's the honest caveat. Research from McLean and Pontiff in the Journal of Finance showed that published market strategies lose about 58% of their edge once everyone starts copying them. The momentum factor is real, but it's getting thinner as more money chases it. One more important detail about SPMO. It has about 44% annual turnover from those semi-annual reconstitutions. That means it belongs inside a retirement account, where turnover doesn't create tax bills. Never hold this one in a regular brokerage if you can avoid it. The allocation looks something like this. About 50% goes to the foundation, VOO, SCHD, and VTV. About 35% to the growth engine, QQQM, SCHG, and VGT. And about 15% to the momentum boost, SPMO. Now you know what each fund does and why it's there, but there's a number that matters more than the return rate. Almost nobody talks about it, and it's the single biggest reason most people never actually get the returns their portfolio earns. The number that actually decides if you get rich. Here's a question. If this portfolio averaged 16% per year over the last decade, why don't most investors actually get 16%? Because the returns don't fail people, the behavior does. Every year, a company called Dalbar studies what real investors actually earn versus what their funds earn. Their 2026 report looked at 20 years of data ending December 2024. The average stock fund investor earned 9.24% per year. The S&P 500 earned 10.35%. That gap sounds tiny, 1.1%. Who cares? Here's who cares. $100,000 at 10.35% for 20 years grows to $717,000. At 9.24%, it grows to $345,000. That's $372,000. Gone. Not because of fees, not because of bad funds, because of behavior. Buying high, selling low, panicking, chasing, quitting.
And it gets worse. JP Morgan's research found that if you missed just the 10 best trading days over a 20-year period, your return gets cut nearly in half. Miss the 60 best days, and your money actually shrinks. You lose 3.7% per year. Now, here's the fact that should stop every panic seller dead in their tracks. 7 of the 10 best trading days happened within 2 weeks of the 10 worst days, and 6 of those 7 came right after the crash. Think about what that means. The people who sold during the worst moments missed the best moments. They locked in the loss and gave away the recovery. Now let's talk about the alternative, day trading. Researchers at Brazil's securities regulator, the CVM, tracked every single person who started day trading equity futures between 2013 and 2015. Of the 19,646 people who kept trading for more than 300 days, 97% lost money. Only 1.1% earned more than minimum wage. Only 0.5% earned more than a bank teller's starting salary. The researchers looked for evidence that people got better with practice. They found none, 0 evidence of learning. And remember Warren Buffett's famous 10-year bet with the hedge fund industry? He bet that a simple S&P 500 index fund would beat 5 hand-picked hedge funds over a decade. The index fund gained 125.8%. The 5 hedge funds returned between 2.8 and 87%. The average came out to about 2.2% per year. Buffett didn't win because he's a genius stock picker. He won because simplicity beats complexity over time. Here's the myth. Active investors beat passive ones. Here's the truth. The less you touch this portfolio, the more it makes you. Your job is not to trade. Your job is to not quit. The portfolio doesn't fail you. The behavior does. 7 ETFs do the work. Your only job is to not quit. Before I show you exactly how to build this, drop a comment right now. How many ETFs are you currently holding in your portfolio? 2, 5, 15? I read every single comment, and I'm curious where you are right now. Your blueprint, build this starting today. Let's bring this home. Let me show you exactly how David and Maria build this. First, account placement matters more than most people realize. SPMO has 44% annual turnover. SCHD pays a 3.35% dividend yield. Both of these create taxable events every year, so those two go inside a 401k or IRA where taxes don't touch them. VOO, VCHG, and VGT are structurally tax efficient. A 2025 study in the Review of Financial Studies found that ETFs deliver roughly 1% more in after-tax returns than comparable mutual funds every single year. That's because of something called in-kind redemptions. Without getting too technical, the ETF structure lets the fund flush out low-cost shares without triggering capital gains, so these 3 work well in a regular taxable brokerage account. VTV and QQQM work in either type of account. Second, you do not need $100,000 to start. David and Maria started with $500 per month, $250 to the foundation, $175 to the growth engine, $75 to the momentum boost. Every single month, automated, set it and forget it. Third, rebalance once per year, 15 minutes. Check if any slice has drifted more than 5% from your target allocation. If it has, point your new contributions toward the lagging slice until it catches up. Research from William Bernstein found that rebalancing bonus adds roughly roughly 0.5% per year to returns. That's not nothing, but the real benefit of rebalancing isn't extra return, it's risk control. It keeps you from accidentally becoming 90% tech during a bull market, which is exactly when a crash would hurt the most. Now, here's the honest part, and I think this matters more than anything else in this video. The Shiller-Cape ratio, which measures how expensive the stock market is compared to its long-term earnings, currently sits at 39.64. The historical median is about 16. We're more than double the normal level. That does not mean the market is going to crash tomorrow. It means expecting 16% returns for the next 15 years is the optimistic case, not the guaranteed case. A realistic range looks like this. Bull case, 14 to 16%. Base case, 8 to 10%. Conservative case, 5 to 7%. Here's the good news. Every single one of those outcomes beats the 4% that David and Maria were earning in their savings account. Even the conservative case turns $100,000 into over $200,000 in 15 years. The base case gets it past $400,000. And remember the compounding curve from the beginning? 2/3 of the money is made in the last 5 years. Starting now, even imperfectly, matters far more than waiting for the perfect moment, because the perfect moment never comes. David and Maria ended up simplifying even further. They looked at the overlap data and decided to start with just 3 of the 7, VOO, SCHD, and QQQM, inside their 401k and Roth IRA. $500 a month, automated. No stock picking, no candle charts, no panic selling. 15 minutes per year. The portfolio does the work. Their only job is to not quit. And they haven't. If someone you care about is sitting on cash in a savings account watching inflation slowly eat their future, send them this video right now. It could change their entire trajectory.